Today I want to have a quick conversation with you about a key question: to pay LMI or to not pay LMI. But before we delve into that, what is LMI? Well, LMI stands for Lenders Mortgage Insurance.
Oh my God, what is that?
Well, if you don't have a 20% deposit, the banks will force you to get Lenders Mortgage Insurance. It's an insurance policy. But why do you have to get it? Or what is it? Well, you're forced to get Lenders Mortgage Insurance by the lender because you have less than a 20% deposit, and the risk, they want the insurance policy to cover the risk. Now, it's very important you understand, Lenders Mortgage Insurance does not protect you, it protects the banks. It protects the banks if you don't pay your mortgage. That's what LMI is. If you're a first home owner that does not qualify for the Home Guarantee Scheme, the Home Guarantee Scheme is where the Australian government guarantees your loan, therefore you do not have to pay LMI. So let's say you don't qualify for that scheme as a first homeowner. Let's say you wanted to buy an $800,000 property, you had a $40,000 deposit, which is 5%. The LMI on that purchase would be roughly $31,939. That's a lot of money. It's almost as much as the 5% deposit. And for this reason, some property experts will say to you, avoid LMI at all costs. Don't pay LMI, it's a waste of money. And the reason why they say it's a waste of money is because it protects the bank and it doesn't protect you. But the problem is, they'll say just keep saving, get a bigger deposit, avoid LMI. The problem with that is while you keep saving, well, let's look at what happens. There's two massive problems. The first one is the amount of time that it takes to save a deposit. So the average time it takes to save a 20% deposit is 8.1 years. I don't know about you, but to me, that sounds like a very, very long time. And what happens to property prices in those 8.1 years? They continue to go up. The property prices continue to go up over the 8.1 year period. To understand that, let's look backwards, not forwards. So what does that look like? If we were to take a market, the Northern Gold Coast corridor, Coomera, Ormo, Pimpama, or that southern Brisbane corridor, Logan style area. If you were to rewind and go back 8.1 years, you're talking 2016. You could have bought a brand new house and land package in those markets for between $400,000 and $500,000. Comfortably, maybe even at a stretch in the high 300s. And what's happened in the last 8 years? Those properties now are selling for between $800,000 and $1 million. So here's what you need to understand. Do you pay the $31,000 or do you wait the 8.1 years and pay $400,000 to $500,000 more for the same property? Next is a thing that we call deposit creep. So let's say you're committed to saving your 20%. You've worked out on your $800,000 property, you need to save $160,000. The problem here is over the 8.1 years, the property prices increase and your deposit amount increases. So to take those examples, if you were going to buy a property 8.1 years ago, and that property was, say, $450,000, you needed to save $90,000. It takes you 8 years to save that, and you arrive at the point now where the property is actually $900,000. So now you don't need $90,000, now you need $180,000. So the money that you thought you were saving to buy the property, it's not enough. We call that deposit creep. As the purchase price goes up, the deposit required goes up. And you're chasing it with savings. Your savings will never outpace the growth in the property market. And for those two reasons, for me, it's a no-brainer, guys. It's a no-brainer. Pay LMI, get into the market sooner, and let the market do the heavy lifting.